The one big beautiful bill was signed into law just this past weekend, and in this video, I'm going to talk you through the tax implications to small business owners. Now, if you are new around here, I am Sarah Young. I am a CPA and the founder of Young & Co., where we provide virtual CFO and advisory services, including tax services and tax strategy to small business owners. And y'all, over the last couple weeks, there has been so much discourse online about this bill. Very, very partisan discourse going on. And I will say that I think a lot of people don't really actually understand that there are real life tax changes that are going to happen as a result of this bill and what it might mean for you and how much you're going to pay as a business owner. So as of the time I'm recording this, it is Monday, July 7th. I almost said January. It kind of feels like almost a year. We're halfway through, starting the second half of the year. And this bill was just recently signed, I think over the weekend. And this morning I sent an email out. We wrote an email to our clients to outline high level some of the tax changes that we see in this bill as compared to what the tax law was before. So I'm not going to outline every single thing in the bill because that would probably take hours. I'm not going to go into detail in it either. The one thing I will say is that as I was kind of researching and making sure I'm saying the right thing, I saw a lot of stuff online that was outdated or incorrect. And so as you're looking for stuff, if you're trying to do your own research, which you absolutely should, just keep in mind that there's going to be stuff online that's either news articles talking about the House version of the bill, which did not pass the original version. There's also people who I was looking up some of the specifics about the Trump savings accounts for kids. And I was looking at some Reddit chains just to see what people were talking about. And there were people who sounded like they knew what they were talking about, but they were saying things that were completely factually incorrect. So just be careful when you are looking for stuff about things like taxes. As always, just make sure that you are getting your information from a reputable source. I would say even from me, don't take what I'm saying in this episode as a hard and fast fact for your own situation. Go talk to your own accountant to make sure that you're going to be able to apply the tax changes to your own situation. Before I dive into some of the tax stuff though, I do want to say a couple of things I think are really interesting just on outside of the tax changes, just because I feel like the rhetoric is so charged around this bill and has been for the last few weeks. I think it's probably going to continue for a while, frankly. So some of the things that I find to be, I don't know if interesting is the right word, but that's the word coming to mind, interesting about this bill is the projected increase in the deficit and also the total national debt over the next 10 years. So looking at sources like the Tax Foundation, which is a nonpartisan nonprofit think tank that focuses on tax policy research, and also the Congressional Budget Office, the CBO. This is an agency within the government that analyzes laws to give Congress some information about, hey, this is the potential impact of this bill that you are about to pass. So both the Tax Foundation and the CBO project that the total deficit is going to increase by $3 to $4 trillion over the next 10 years as a direct result of this bill. And that is after factoring in what they're projecting to be economic growth as a result of this bill, offset by the tax cuts and offset by the increase in spending in some other areas. But primarily the number one thing that's increasing the deficit, which is how much the federal government is short and we have to incur debt to cover this deficit. The primary thing impacting the deficit is the extension of the 2017 Tax Cuts and Jobs Act, which we'll talk about shortly. And this increase in the deficit also comes after the projected cuts to things like Medicaid, SNAP benefits, etc., which is what a lot of people really don't like, myself included, frankly, about this bill, is that we are taking from some of the most vulnerable people in our population to fund some of these tax cuts. The Yale University Budget Lab also did a study. They projected that this bill will on average cost the bottom 20% of taxpayers an average of $560 per year, meaning they're going to pay more partially as a result of the loss of some of these benefits. And then offsetting that on the top 20% of taxpayers, they are going to get an increase in income of about $6,000 per year. And just also at a high level, I think this is really important to think about with any long-term tax strategies that you're doing. A lot of people that I talk to are really focused on short-term tax strategies, which is fine. I know that we really like to save money in the short term, especially if you're a business owner and you're able to take that money and plow it into something else that is going to make you more money. Totally on board with that. But one of the things I think we need to keep in the back of our minds is long-term, what are taxes going to look like? And obviously no one knows, but with the government having been in a deficit since, I actually looked it up, the last time we were in a budget surplus, meaning we brought in enough revenue to cover all of the government spending, was back in 2001. As of right now, about 13% of the federal budget goes toward interest payments on the debt that the government has incurred on running a deficit. This is not sustainable. I'm not by any means a government or economy policy expert, but at a high level, but continuing to run this deficit, continuing to run up the national debt forever and ever is not sustainable. And there will come a point where something has to give. The problem is what has to give is either we have to increase taxes, because remember, taxes for the government is revenue. So what they collect from taxpayers is revenue coming in, or they have to cut back on spending, which becomes harder when a bigger and bigger portion of your budget goes to interest payments, just like in your household, maybe not just like, but similar to how in your business or in your household, when you incur more debt and you have high debt payments, that eats up your cash flow every month. The same thing, just on a much, much larger scale, is happening to the federal government. You know, currently in the next 5 to 10 years, maybe we can keep doing what we're doing, but there will come a time when something is going to have to give, because we cannot just continue to issue debt with no end, right? So that's just one thing I think is really interesting in terms of this bill, because this bill is projected to continue to increase the deficit by such a drastic amount. Okay, so I'm going to run you through in two groups some of the key business tax provisions and some of the individual tax provisions. So starting with the business tax provisions, when I look at these, I think the number one biggest change is that this bill re-upped the bonus depreciation percentage. So bonus depreciation was 100% after the 2017 Tax Cuts and Jobs Act was enacted, and then it started decreasing by 20% per year, so that it was 40% bonus depreciation in 2025, meaning let's say you buy a piece of equipment for $10,000, you want to do bonus depreciation, you can only take a 40% upfront deduction for that, so $4,000, and then the rest of it gets depreciated over 5 years or whatever the life is of that piece of equipment. So that bonus depreciation was brought back up to 100% effective in 2025. To me, when I look at all of the changes, I think that is probably the number one biggest change. Section 179, which is another form of accelerated depreciation, the cap on that was increased. You could only do like 1.25 million, I think, through 2024 in 179 depreciation, which is again 100% in the year placed in service. But with the One Big Beautiful Bill in 2025, the cap on that was increased to $2.5 million. So still 100%, but the cap was higher, so you can deduct more in the year that you place something into service. Now, the key difference between bonus depreciation and 179 depreciation is, I would say, that Section 179 depreciation cannot cause you to have a loss in your business. So let's say you open a location for your business. Maybe you have a massage or spa, right? You open a second location, you have all of the cost of building out the building, you have all the equipment, etc. And let's say it costs you $500,000 to build that location out. And for the year that you opened it, let's say you have before depreciation $100,000. If you take 179, you cannot deduct more in the current year. You can't deduct more than $100,000 in expense. So that out of the 500, you get to deduct 100, take your income down to 0, and then the remaining 400 gets carried forward to the next year. Versus bonus depreciation, with bonus depreciation being at 100%, you can take 100% deduction in the year you place the assets into service, but there's no restriction on business income for how much you can deduct. So if you do bonus depreciation, you can take the whole $500,000, and then depending on your basis, so like if you funded that build out from profits from the business or out of your own pocket, then you could probably take that whole $500,000 as a deduction in the year you place those assets into service. The other biggest change, and this isn't really a change, but the other biggest thing I think that will impact people is that the qualified business income deduction, or QBI, you might also hear this called Section 199 deductions, is 20% of business income you get to take as a deduction off your personal return unless you have a C Corp. So this was slated to end at the end of 2025, to just go away after this year, but it got extended and made permanent. And so that means we get to keep taking the QBI deduction. Okay, a couple other random some things, 1099 reporting. So the reporting threshold for filing 1099s for if you're paying other people in your business was $600 in a year. That was increased to $2,000 per year. So that means presumably you have less 1099s to file. Hooray. R&D expenses. If you are a business that incurs R&D expenses, which is not super common, but there are some, especially if you're doing any kind of software development, I would say it's more common. You get full expensing for qualified domestic research and development costs. Previously, you would have had to capitalize those costs and amortize them over 15 years. The employer tip credit. So we have some spas, some beauty type businesses as clients, and they could never take the employer tip credit, which is a credit that the food and beverage industry employers would get on payroll taxes paid on employee tips. So basically, employees get tipped, they report those earnings, the employer pays payroll taxes on the tips. This gives them a tax credit for those payroll taxes. We're going to talk about the employee tips in a second, so don't get the two confused. But this expands it to the beauty service industry. So more businesses that generally would get tips can take this tax credit if you have that type of business and you have employers. Again, you're going to want to make sure you qualify, but it's generally beauty service businesses. Those are the biggest changes that I'm seeing to businesses. Yes, there are more changes that went into place, but when I think about our clients, these are the ones I think that most of them are going to see an impact from. Let's talk about some of the individual tax changes. So here's the biggest ones. I'm going to kind of run down the list. The standard deduction was increased from, it was $30,000 married filing jointly for 2025. It's now $31,500, and that will increase year over year with inflation. If you're single, it was increased to $15,750. Some of the kid-related tax credits and tax benefits were increased. So the child tax credit was increased to $2,200 per child. The dependent care credit, you now get to calculate it on 50% of qualified expenses. And then if you have a dependent care FSA, so like for example, my husband is employed and he has a dependent care FSA set up through his employer. He has that set up for $5,000. That limit was increased to $7,500. So actually, interestingly, that FSA provision was set up like, I think it was in the 70s, if I'm not mistaken. It might have been the 90s. Either way, a long, long time ago. And it was set at $5,000 and it was never increased. So you can imagine how much more we know childcare costs now compared to how it used to. So this increases that to $7,500 for 2025. This might also impact you if you have that as a benefit. If you are an employer and you're offering that as a benefit, that could also be a good benefit to offer to your team. The charitable contribution deduction, this one doesn't count for 2025, but looking at 2026 and onward, even if you don't itemize, there is a $1,000 single, $2,000 married filing jointly deduction that you can take for charitable contributions, even if you don't itemize. We have a lot of clients that will make charitable contributions through their businesses, and then that flows through to their personal return, but then they don't itemize on their personal return, so they don't really get the tax benefit from making that donation. And so this will give you, if you're married, $2,000 a year that you can deduct, even if you don't itemize your deductions. All right, now let's talk about tips and overtime. So I keep seeing this no tax on tips and no tax on overtime be talked about a lot. This is a misnomer because there is going to still be tax on tips and overtime. For tips, there is now going to be a $25,000 deduction for qualified tips, meaning you received the tips in an occupation that regularly receives tips, subject to an income phase out. However, if these tips are reported on your W-2 as they should be, or if you're an employer who has employees who receive tips, you still have to pay payroll taxes and the employee still has to pay payroll taxes on those tips. They're also still subject to income tax withholding, at least for 2025. So if you are an employer, you will need to be thinking about how do we separately report those tips from W-2, other W-2 wages, because your employees are going to want to be able to show that they made enough tips to get that deduction. Overtime is similar. There is a $12,500 deduction, or double that if you're married, for qualified overtime. This one, I felt like the description was not as clear, but basically it is a deduction for qualified overtime, which is if you have a non-exempt employee working more than 40 hours in a week and they get paid time and a half. So if your team is subject to those laws of being paid time and a half, then that overtime is able to be applied for that deduction. And so that, again, is something that you as the employer are going to want to be able to report separately on your W-2s. It doesn't sound like to me, though, that if you have employees who work overtime but are not qualified for time and a half, that would count toward that deduction. The next one I think is really big is the state and local tax cap. This is the SALT, state and local tax. If you itemize your deductions, you would get a $10,000 cap on state taxes. So if you pay $10,000 in state taxes, cool, you get to deduct that. But if you are like a lot of our clients who have a high income and or they have business income and they're also married to somebody who has a pretty high income, then your state taxes very easily exceed that cap. So that cap was increased to $40,000 for 2025, and it will be, I believe it will be increased for inflation. It's in effect until 2030. The workaround for being able to deduct state taxes for business owners is to do the PTE tax, or pass-through entity tax. So if you have an S-corp, a partnership, you can elect to pay the income tax on your business at the business level through your S-corp or through your partnership, and then you get that as a straight deduction from your business income on your federal return, and so it's a workaround. As to whether with the increase in the cap it is applicable, this is going to be beneficial for you to keep doing the PTE election or not, is going to come down to tax planning, meaning what we're going to have to do for our clients and what you will want to talk to your accountant about, or come find one who can do this for you, is sitting down and running the numbers and saying, are you still going to meet the cap? Are you going to be under it? Are you still going to take the standard deduction? Like, figuring out if the PTE election continues to be more beneficial to you is going to be something that you want to do with tax planning. And if you're still taking the standard deduction, which could be a lot of people because the standard deduction was just increased a little bit more, or if you're in a high tax state where your state taxes are still going to be in excess of $40,000, or let's say you have a very high income and so your state taxes are still in excess of that 40K cap, then it might be beneficial to you to keep taking the PTE. This one is harder to say without doing some sort of calculation. Okay, next, car loan interest. Actually, also want to talk about some of the clean energy tax credits. So there is up to a $10,000 deduction on interest expense paid for new car loans, and they must be on U.S. assembled cars that you can take even if you don't itemize. So if you go buy a car and it's US assembled, then you can deduct up to $10,000 a year in that interest expense, which is great. On the flip side, some of the tax credits for buying electric vehicles are basically all going away after 2025. And this also goes for a lot of the like home improvement, business improvement type tax credits for energy efficient stuff. So those tax credits are going to go away. And so I've heard people saying like, well, maybe I'll go buy that electric car that I've been thinking about buying because the tax credit will go away after this year. And then it would also qualify if it was assembled in the US for the car loan interest expense deduction. I always like to say that the tax code is a system of incentives. So they're trying to incentivize people to buy cars, clearly, but they don't want you to buy electric cars because they're taking away that tax credit. And so I just think it's interesting that this is what the incentive is. I also am kind of thinking through like the implication of tariffs and wanting to bring manufacturing back into the US. And so they're trying to create an incentive for more manufacturing, more vehicles to be made in the US because more people are going to be buying US vehicles because of the tax incentives. I just think it's really interesting how all these things play out, whether you agree with them or not. Okay, and then the last couple of things I'm going to talk about are the Trump accounts, or the tax-free savings accounts for kids. I would say they're not really tax-free. I keep seeing that terminology online, being tax-free, but they're more like an IRA setup for minors, but the expenses, you don't have to wait until retirement to take withdrawals. So these savings accounts will be set up to where you can make contributions to the accounts in the years before the beneficiary turns 18, and then they can take distributions in the year starting when the year they turn 18. I read through the actual code and I am not super clear. I'll have to like do some research and see what other people's analysis look like. I'm not super clear on what the distributions are for and what the tax rate is. I saw some stuff that said it would be taxed at long-term capital gains taxes. I saw some stuff that said you'd have to wait until you were older to be able to take money out. Unclear, okay? But starting to take distributions in the year they turn 18. For children born from 2025 to 2028, basically the government via a tax credit will contribute $1,000 tax-free to you, meaning you put $1,000 in, or they put $1,000 in for your kid or on the behalf of your family for your kid, and then you don't pay taxes on that income. You can also contribute up to $5,000 a year, and that limit will be indexed for inflation. But I also read that there's no contributions allowed until 1 year after the bill is signed. So I feel like they want to maybe like keep tweaking the way that these are set up. Not totally sure. Contributions themselves, this was a really big error that I saw a lot of people saying online. The contributions that you put in are not tax deductible, but the growth happens tax-free, well, tax deferred. And the withdrawals later on may be subject to more advantaged, lower tax rates. And then the last thing I thought was interesting, again, if you are an employer, this might be an interesting benefit to offer. Employer contributions up to $2,500 are not included in the employee's income. So you as an employer could offer that as a benefit for your employees, and then your employee doesn't incur income taxes on the contribution that you make for their kids. Along similar lines, 529 accounts, which are the accounts for school expenses. Most people think about these for college expenses, but they actually expanded the benefits. We've been able to use it for K through 12 expenses, but they expanded to cover more K-12, homeschool, and even some post-secondary credentialing expenses, such as getting a CPA license. You can use 529 money to fund that. I feel like this was obviously a very different episode style than what I normally do. I know I normally talk about strategy, but I know that the impact of this bill is something that is on the minds of pretty much all of our clients, and we're thinking about as we go into our tax planning calls, which we typically will do with our monthly clients in Q3, starting in late, we're in Q3 and then early Q4. And I know it's something on the top of mind. And so I think thinking about, are there ways that you can use some of these things to your advantage? Whether you like the bill or not, I think it's really important to understand the impacts that is going to have on you, because these things will probably be encodified. Is that a word? Encodified for a long time. Like a lot of these things originally, when the Tax Cuts and Jobs Act was put into law back in 2017, and they were set to be phased out now, when they were hoping that Trump or another person, I guess back then in 2017, they were hoping that Trump would have gotten the second term and then this would be a different president. And so they typically like for these things to start phasing out when somebody else is in office so that they can blame that person for them being phased out. But a lot of the things in this law, in this version, some of them will be phased out, but then some of them were made permanent. And so I just think it's really important to understand how all these things will impact your taxes, because while I don't think we should be making decisions solely for the sake of taxes, I do think it's just really important to understand, like, what are some ways that we can legally work within the system to pay less in taxes, and how does that factor in to your long-term wealth strategy? And I guess I also started talking about this earlier, but just thinking through like the fact that this bill is going to increase the deficit, and I see no signs anywhere of anybody talking about how can we get our budget back in balance and start reducing some of the national debt. And there's actually a really interesting book, and it's a documentary on Netflix called The Power of Zero, where they just talk about this looming national debt and how the authors of the book think that the only way out of it is going to be to raise taxes, which of course nobody knows for sure what's going to happen. But I guess point being, no elected official right now wants to campaign on the fact that we're going to cut the national debt by making everybody pay a lot more taxes. But at some point, something's got to give, and we don't know what that's going to be. And so just thinking longer term about how can we use these things now, yes, to pay less taxes, but how can we set ourselves up to make sure that we're building wealth in a way that's tax advantaged, so that later on in life, you're not going to be as subjected to potential changes in tax rates. If you're my age, I am not in any way factoring in Social Security, Medicare, any of that, Medicaid, Medicare, Medicaid into my long-term plans. I'm assuming that I'm going to get none of it because it will very likely not have any funding by then. So, very different episode than I normally post, but hopefully this was helpful to walk through it and maybe thinking about it with a little more of a level head than some of the rhetoric that we're seeing online. If it was helpful, make sure you comment under the episode in YouTube and let me know, and I will see you back next time.